Welcome back to the deep dive. Today we're talking about something you've probably seen advertised 1,000 times, refinancing.
We have, yes.
And our mission for this deep dive is pretty simple, but it's also, I think, really crucial. We want to give you the knowledge to figure out when refinancing is a genuinely clever financial move.
And when it's actually a trap, a really costly trap.
Exactly. We're going to unpack all the layers, hopefully in one single source of information for you.
And it's important to realize right from the start that this isn't just about your personal credit score. The source material makes it very clear that the terms you get, they can vary wildly.
Right. It's not just about you.
Not at all. It's about huge macroeconomic forces. Things like, the political stability of the country, the stability of the currency, the whole banking regulation landscape. These are all things that are completely outside of your control, but dictate the rate you're offered.
That's where it gets so interesting. It's not just about filling out a form. It's about this kind of global calculus that's happening in the background. But before we get into why someone would do this, we need to make a really key distinction.
A very key distinction.
The difference between refinancing and something else called debt restructuring.
Yes, and that distinction really defines where the borrower is coming from. So when we're talking about refinancing, we're talking about a proactive, strategic move.
You're in a position of, let's say, relative financial health.
Exactly. You're looking to manage future risk or maybe just capitalize on lower interest rates in the market. It's a choice you make from a place of stability.
But if that same process, that replacement of debt, happens because the borrower is already in some kind of financial trouble, maybe they've missed payments or they're about to default,
then it's not refinancing. That's called debt restructuring. And that's a whole different world. It often involves formal negotiations, waivers, maybe even court-supervised agreements. It signals financial distress.
Got it. So today we're focusing on the strategic choice refinancing and all the hidden costs and risks that come with it.
That's right.
Okay, let's dive into that strategic side then. Section 1, the 5 core motivations for refinancing. These are the real goals that drive someone to go through all this paperwork.
And we really have to get past this idea that everyone just does it to get a better rate. The source shows that these motivations can reveal some pretty sophisticated financial planning. Or
the opposite.
Or, conversely, a worrying sign of some kind of financial strain, either happening now or coming down the road.
Okay, let's start with the most common, the cleanest reason. Number 1.
The first one is the one everybody thinks of, simply seeking a better interest rate. This is the classic strategic move. It usually happens when market rates have dropped well below the rate on your current loan.
And the goal there is one or two things, right?
That's right. You're either aiming for a lower monthly payment, which frees up your cash flow, or you keep your payment about the same, but you drastically shorten the loan term.
Which saves you a ton of money in the long run.
A massive amount in total lifetime interest. It helps you pay off the debt much, much faster.
That's the ideal scenario. But now we get into the motivations that carry some bigger, longer-term risks. What's reason number 2?
Reason number 2 is debt consolidation. This is incredibly common, especially for homeowners in the U.S.
So this is where you take a bunch of different debts and roll them into one payment.
Exactly. You're simplifying things. You take multiple high-interest debts, think credit card balances at 20%, personal loans, things like that, and you roll them into one single loan. Usually that means shifting all that high-interest debt into your home mortgage.
And on the surface, that sounds like a huge win. You go from a 20% credit card rate to, say, a 6% mortgage rate. Why does the source flag this as a potential distress signal?
It's all about the term length. That's the trap. Credit card debt is short-term debt. You're supposed to pay it off in a few months, maybe a couple of years.
Right.
When you take that $20,000 in credit card debt and roll it into a new 30-year mortgage, you are now paying interest on that $20,000 for 30 more years.
Oh, wow.
So even though the rate is much lower, the massive increase in the repayment period can mean the total interest you pay on that specific chunk of debt just skyrockets.
Yeah.
It's a good short-term fix for cash flow, but it can be a huge long-term financial penalty.
That's a penalty you could be paying for decades. Okay, what's the third motivation? This one sounds like it's purely about survival.
It often is. Number 3 is to reduce the monthly repayment amount.
Yeah.
This is just laser focused on immediate cash flow relief.
Maybe you lost some income or your expenses went way up.
Precisely. And you achieve this by stretching out the loan term. Say you had 20 years left on your mortgage.
Yeah.
You refinance back into a brand new 30-year term.
So you're paying less each month because you're spreading it out over more time?
Exactly. But the trade-off is unavoidable. This approach, depending on the fees and the new rate, almost always results in paying significantly more in total interest over the life of the loan. You're buying short-term relief at a very high long-term cost.
So if debt consolidation is about simplifying and payment reduction is about surviving, what about reason 4? It seems to be more about security.
Reason 4 is purely a defensive move, altering risk. The classic example here is switching from a variable rate loan like an adjustable rate mortgage or an ARM to a fixed rate loan.
Where the rate can jump all over the place.
Right. With an ARM, your payment could go up every year. A fixed rate loan gives you predictability. Your payment is stable for the entire life of the loan, no matter what the market does. That predictability is a really valuable risk-reducing thing to have in your financial plan.
And finally, number 5, which is about accessing capital you already have.
Yes, freeing up cash. And this is different from debt consolidation. Here, you're refinancing specifically to tap into the equity you've built up in an asset, usually your home.
So you're not paying off other debts, you're just taking cash out.
Correct. You're accessing liquidity for something else. Maybe funding a college education, paying for a big medical expense, or even making another investment. But again, it's often done by extending the term, so you have to watch those long-term costs.
Okay, so let's tie this back to what you said about financial health. For anyone listening, which of these 5 are the real red flags?
Well, the source is pretty clear on this. Reasons 2, 3, and 5. So debt consolidation, reducing the monthly payment, and freeing up cash. Those are very often undertaken by borrowers who are already facing some kind of financial difficulty.
They need cash, and they need it now.
They do. And it might be a rational choice for their immediate situation, but they have to understand the penalty they're paying. They are almost certainly staying in debt for longer and paying more for it in the end. It's a costly trade-off.
And before we move on, we have to mention one specific detail for U.S. home mortgages that our source brings up: the tax advantage.
Absolutely. One of the big selling points for refinancing in the U.S. is that you can often deduct the interest you pay on that mortgage debt from your taxes.
But there's a huge catch.
A very often overlooked catch. This benefit is contingent on the borrower not paying something called the alternative minimum tax, or AMT.
Okay, we need to unpack that for a second. What is the AMT and why does it mess with this tax benefit?
The AMT is basically a parallel tax system. It was designed to make sure high-income taxpayers can't use too many deductions and loopholes to avoid paying a certain minimum amount of tax.
And it affects mortgage interest?
It can, yes. If your income puts you into the AMT, several standard deductions get limited, or they just disappear entirely. And one of the big ones is the deduction for interest on home equity loans or refinance debt that isn't used for substantial home improvement.
So if you refinance to consolidate credit card debt,
that tax deduction you were counting on might just vanish under the AMT rules.
Yeah.
It suddenly makes the whole financial move a lot less attractive. It's another layer of calculation you absolutely cannot ignore.
It just makes that cost-benefit analysis even more complicated. Okay, so we established the why. Now let's get into section 2. The critical calculations. This is where we go beyond the flashy headline rate and really look at the risks and hidden costs.
This is the make or break part of the decision. If you only look at that new, lower interest rate, you are setting yourself up for failure. We have to dig into the actual costs that make this a transaction, not just a simple rate swap.
Let's start with the fees from the loan you're trying to get away from.
We're talking about prepayment penalties. You might see them called call provisions in your loan documents.
And these are basically a fine for paying off your loan early.
That's exactly what they are. Some fixed-term loans have these clauses that penalize you if you pay the loan off early, either in part or in full. Since refinancing is, by definition, paying off the old loan entirely, these penalties become an immediate upfront cost you have to add to the whole equation.
And then you have the costs of the new loan itself.
Yes, the transaction and closing fees. And this is a whole list of things: application fees, attorney fees, title searches, insurance, underwriting fees, and, a big one, appraisal costs. You have to add up every single one of these.
Because the savings have to cover all of that before you actually start saving money.
Precisely. You gave a great example. If the fees are $5,000 and you're only saving $100 a month, it takes you over 4 years just to break even. If you sell the house in 3 years, you've actually lost money on the deal.
That's the core calculation right there.
And just a quick legal point. These penalties only apply if you pay the loan off before its maturity date.
Yeah.
If your 30-year loan ends after 30 years, that's not refinancing. That's just the end of the loan. No penalties there.
Right. Now let's talk about the biggest, most common mistake people make. The source calls it the total interest trap.
This is so important to understand, especially for people who are desperate to lower their monthly payments.
Walk us through an example. Let's use some real numbers.
Okay, let's imagine a homeowner. They have a 30-year mortgage, and they've been paying it for 15 years. Their current rate is, say, 5.5%. They have $100,000 left to pay over the next 15 years.
And they see that today they can get a new loan at 4.5%. Sounds great.
It looks great on the surface. Now, they have a choice. They could take a new 15-year loan at that lower rate, which would be fantastic, but they're focused on cash flow. They want the lowest possible payment.
So they refinance that $100,000 back into a new 30-year loan.
Exactly. Back to a full 30 years, just at that new 4.5% rate.
What's the consequence of that decision?
It's devastating to their long-term wealth. By stretching that $100,000 back out over 30 years instead of the remaining 15, they dramatically increase the total interest they'll pay.
How much more?
If they'd had stuck with their original loan, they would pay about $46,000 in remaining interest. With the new 30-year loan, even at the lower rate, they'll end up paying roughly $82,000 in interest.
Wait, hold on. So by getting a 1% lower rate, they ended up paying $36,000 more in total interest.
Exactly. Because they added 15 years back onto the life of the debt. The source is crystal clear on this. Refinancing only really makes sense if you get a lower rate and you manage the term length to minimize the total interest. The goal should be getting out of debt sooner, not just paying less this month.
That is just a stunning comparison. So to sum it up, what's the one essential comparison a borrower has to make?
It's a three-part calculation. You have to add up 1, all the closing costs on the new loan, 2, any prepayment penalties from the old loan, and 3, the total interest you'll pay over the entire life of the new loan.
And you compare that big number?
You compare that total cost directly against the remaining interest you would have paid on your existing loan. If that new cost isn't substantially lower, you're probably better off just sticking with what you have.
Let's shift to another technical aspect. The upfront payments, known in the U.S. as points.
Right, points and premiums. In the U.S., it's just a common way to price a loan. The lingo is simple. 1 point is 1% of the total loan amount.
So on a $300,000 loan, 2 points would be $6,000.
Exactly. $6,000 you have to pay up front at closing.
And what's the trade-off? Why would you pay that?
You're essentially buying a lower interest rate. The general rule is the more points you pay up front, the lower the interest rate the lender will offer you. You're prepaying some of the interest to get a lower payment for the life of the loan. It can be a good move if you plan to stay in the home for a very long time.
What about the opposite? The source mentions negative points. How does a lender give you a discount?
Negative points, or a lender credit, is when the lender offers to help cover your closing costs. But, there's no free lunch.
Of course not.
In exchange for that credit, the lender will offer you a slightly higher interest rate. So you're trading a little bit of your rate savings to reduce the cash you need to bring to the table at closing.
That makes sense. But before we leave this technical section, we have to talk about a really serious and often hidden danger: the recourse debt risk.
This might be the most overlooked and most important detail in our source material. It's a fundamental change to your liability, and it's specific to certain jurisdictions in the U.S. It varies state by state.
So in some states, a refinanced mortgage can become what's called recourse debt. What does that mean for you if you default on the loan?
It means you are personally on the hook for the entire loan amount. If you default, the bank forecloses, they sell the house. But let's say the sale doesn't cover the full loan balance.
The house is worth less than you owe.
Exactly. Let's say there's a $50,000 shortfall. With recourse debt, the lender has recourse to your other assets. They can come after your savings accounts, garnish your wages, seize other property to get that $50,000 back.
That is absolutely terrifying, and this risk is introduced specifically by the act of refinancing.
That's the crucial part. In those same states, the original mortgage you got to buy the house might be non-recourse debt. That means if you default, the lender's only option is to take the house. They can't touch your personal wealth.
But refinancing can change that protection.
It can. By refinancing, especially if you take cash out, you might accidentally convert that protected non-recourse loan into a fully unprotected recourse loan. It's a massive risk you have to check with a local expert before you sign anything.
A stark warning. Seeking a better rate could end up exposing your entire family's financial future. Okay, let's shift gears now to Section 3 and look at how refinancing works for different kinds of debt.
Right, it's not just for houses. It applies to student loans, personal loans, but we're going to focus on the two biggest ones from the source: mortgages and auto loans.
Let's start with mortgages. The source breaks it down into four different objectives.
The first is what we've mostly been talking about: rate and term refinancing. This is the standard definition. You're just replacing the old mortgage to get a new rate or a new term. You're not really changing the loan balance.
Simple enough. Next is the one that gets popular when home values are rising.
That would be cash-out refinancing. This is where you tap into your home's equity. If your house has gone up in value, you can borrow against that new value. But this, by definition, means your new loan balance will be higher than your old one because you're taking out cash.
And the opposite of that is cash-in refinancing.
Cash-in refinancing, yes.
Hmm.
It's less common, but it can be very strategic. This is where you, the homeowner, bring your own money to the closing.
Why would you do that?
You pay down the principal balance to hit a specific loan-to-value ratio, maybe 80%. Hitting that target might qualify you for a much better interest rate, or it could let you get rid of your private mortgage insurance, your PMI, which saves you money every month.
So you're investing cash today for a better deal tomorrow. And the last one is specific to government loans.
That's streamlined refinancing. This is a faster, easier process that's only available for government-backed loans, like FHA and VA loans. The big benefit is you get to skip expensive steps, like a full appraisal or deep credit checks, making it much quicker and cheaper.
Okay, let's move from the house to the driveway. Auto loan refinancing. It's the same basic idea, right?
The structure is similar, yes. You're replacing an old car loan with a new one to get a better term or rate, but the asset itself makes the process and the risks fundamentally different.
How does something like cash out work for a car, and what's the big risk difference?
You can do a cash-out refi on a car if it's worth more than you owe, but the bigger risk, the huge difference, is depreciation.
A house usually goes up in value over time. A car starts losing value the second you buy it.
Precisely, which means that total interest trap we talked about is even more dangerous. With a house, you hope the asset's value is growing. With a car, the collateral is constantly shrinking in value.
So stretching out the loan term is even riskier.
Much riskier. If you take a car loan with 3 years left and refinance it into a new 7-year loan just to lower your payment, you're almost guaranteeing you'll be upside down, owing more than the car is worth for a very long time. If the car gets totaled or you need to sell it, you could be in a really bad spot.
That's a great point. The risk of being perpetually underwater is much higher.
Okay, we've covered the fundamentals. Let's move to Section 4. Advanced strategies. These are specific ways to get around the biggest hurdles to refinancing.
Right, things designed to address upfront costs or being underwater on your loan. And we'll start with the most popular offer you see: no closing cost refinancing.
The appeal is obvious. You get a lower rate without paying thousands of dollars up front. Why is this a good option for some people? It's all about your time horizon, your holding time. We said before, if it takes 5 years to break even on your closing costs, but you think you might sell your house in 3 years, then this is a great option.
Because you avoid losing money on those fees.
Exactly. You get the benefit of a lower rate for those 3 years without making an upfront investment that you know won't pay off. It reduces your risk.
But even with a true no closing cost loan, there's one fee you'll almost always have to pay.
Yes, this is a specific regulatory detail: the appraisal fee. Lenders and brokers are not allowed to pay for the appraisal. So that fee will always show up on your settlement statement, and the borrower has to cover it.
So let's peel back the layers on how the lender actually covers all those other costs. We need to talk about something called the yield spread premium, or YSP.
This is a bit complex, but it's the core mechanism. The YSP is basically a commission that the lender pays to the mortgage broker. And they pay it because the broker originated the loan at an interest rate that's a little bit higher than the lender's base rate.
So the lender gets a better long-term profit from that higher rate.
And they share a piece of that extra profit back with the broker as their compensation. The broker then uses that commission, the YSP, to pay your closing costs for you.
And you mentioned that brokers who do a lot of business can get a better deal.
Yes, a high-volume brokerage often gets an enhanced YSP from their lenders. This puts them in a great position. They might be able to get enough YSP to cover all your closing costs and still offer you a rate that's just as good or maybe even better than if you went directly to the lender yourself.
This whole system was kind of the Wild West until a federal law, RESPA, was updated.
The Real Estate Settlement Procedures Act, yes. The 2011 update was huge for transparency. Before that, brokers could pretty much decide how much of the YSP they wanted to keep. The new law forced them to have fixed pricing agreements.
So they could only keep a set percentage.
A set percentage is their pay, and the rest had to go toward the borrower's closing costs. It cleaned things up a lot and gave consumers much more clarity.
That was a big step. So let's go back to the trade-off. Why is a no closing cost mortgage usually not the best choice if you know you're staying in the house for the whole 30 years?
Because if you're in it for the long haul, your only goal should be to minimize the total interest you pay. That slightly higher interest rate you took to avoid the closing costs will end up costing you way more over 30 years than the few $1,000s you saved in fees up front.
So for long-term owners, paying the fees to get the absolute lowest rate is the better financial move.
It is, mathematically.
The source has this great example about payment parity. Can you walk us through that?
Yes, this is a great little mental trick. Sometimes you'll see two options where the monthly payment is exactly the same. Option A is a 4.5% rate, but with $3,000 in closing costs. Option B is a 4.625% rate, but with zero closing costs. The payment is identical.
Which one do you choose?
You choose the higher rate with no fees. Option B.
Why if the payment is the same?
Because with the no-fee option, your starting loan balance is $3,000 lower since you didn't have to pay or finance those closing costs. If your payments are identical, you're starting with more equity in your home right from day one, without changing your monthly budget at all.
That's a fantastic insight. That leads us right into the last set of strategies, programs that help homeowners who are underwater using no appraisal required refinancing.
This was a direct response to the housing crisis. The government authorized several programs to get around the biggest roadblock for underwater homeowners.
Yeah.
The appraisal. Because low appraisal would just confirm they had negative equity and they'd be denied.
So these programs just skip that step. Let's start with the FHA Streamline Refinance.
This was mainly for people who got their FHA loan before a specific date in 2009 because those older loans had really low mortgage insurance rates. The streamline part means no appraisal, so negative equity wasn't a problem.
And it had a really flexible rule about who could use it.
A very flexible rule. The source notes that you could use it even if you didn't live in the house anymore. It could be a rental property now, and you could still get that refinancing.
Next up, the program for veterans.
That's the VA loan refinance, or the IRRR. It stands for Interest Rate Reduction Refinancing. It's just for veterans who want to lower their rate. And again, no appraisal required. And like the FHA program, it's available even if the veteran has moved out and is no longer their primary residence.
And then there's the big one everyone remembers from that time, ARP.
Yes, the Home Affordable Refinance Program. The first version, our ARP1, didn't really work that well. It had a cap on the loan-to-value ratio. You couldn't be too far underwater.
So it excluded the people who needed the most help?
It did. The game changer was the update, our ARP2. The key feature was that it completely removed that loan-to-value cap.
What did that mean in practical terms? Why was that so important?
Before HARP2, if you owed more than 125% of your home's value, you were out. HARP2 said it doesn't matter. You could owe $200,000 on a home that's now worth $50,000. You were still eligible. That one change opened the door for all the severely underwater homeowners and finally made the program effective.
And quickly, let's touch on the USDA Home Loans Program. Very specific rules here.
Very niche. First, your current loan has to already be a USDA loan, and the house have to be in a designated rural footprint area. Second, the credit rule is unique. They don't even pull a credit report as long as your mortgage is current and you made every single payment on time for the last 12 months.
So they value that payment history above all else. Any other restrictions?
A big one.
Yeah.
You cannot take any cash out. You can only finance your current loan balance, plus the new USDA guarantee fee, which is their version of mortgage insurance.
We've covered a ton of ground here, from the motivations all the way to these really specific government programs.
And the main takeaway, I think, has to be the need to do the math. Refinancing can be a powerful tool, but it's also deceptive. That lower rate is just the start. The real decision comes down to a careful calculation of all the fees and the total long-term interest you'll pay.
And before we wrap, there's one more detailed rule we have to bring up. It's about when a simple consolidation gets classified as a cash-out refi, even if you don't get any cash. The 12-month rule.
Yes, this is a gotcha for anyone combining a first and second mortgage. Let's say you have your main mortgage. 6 months ago, you took out a home equity line of credit, the ELOC, to pay off some bills.
And now you just want to combine them into one simple payment.
Right. You're not getting any new cash out of the deal. You're just paying off existing debt. But because that second mortgage was opened within the last 12 months, the lender will automatically classify the entire transaction as a cash-out refinance.
And what's the penalty for being labeled cash out?
Cash-out refinances almost always come with higher interest rates and stricter lending requirements. So just because you took out that second loan recently, you end up getting a worse deal on the new combined loan. It's a perfect example of these complex rules that can catch you by surprise.
That is exactly the kind of detail that makes this deep dive so important. Okay, for our final provocative thought, the source brings up a really interesting psychological concept: refinancing burnout.
It's this observation that after a period of high market volatility, rates go down, then up, then down again, people just sort of stop refinancing.
Yeah.
Their tendency to chase the next best rate drops off.
And the question is why? Why does the very volatility that creates these opportunities eventually lead to people just giving up?
Right. Is it the mental exhaustion? The endless paperwork, the fees, the constant calculations? Is there a point where a borrower just says, you know what, my rate is good enough, I can't go through this process again?
Even if they know they're leaving money on the table.
Even if they know a slightly better rate is out there that could save them thousands in the long run. It suggests that at some point, the transaction cost, both the financial cost and the mental cost, becomes too high to bear. People get burned out.
A really fascinating look at the human side of all this financial engineering. If you are thinking about these trade-offs, the source suggests looking into related topics like remortgage, which is the British term, or the broader idea of refinancing risk.
Definitely some good homework if you're navigating these decisions.
Thank you so much for joining us on this deep dive. We'll catch you next time.